Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Welcome everybody to the Land to Lots podcast. My name is Carter Froelich, and I'm happy to be bringing you today Greg Vogel, the founder of the Land Advisors organization. Greg, thanks for being here today.
It's an honor, Carter.
And even though we office down the hall from one another, we very rarely see one another. So I'm great to be able to sit down and talk to you about the real estate market across the country. So before we get going today, Greg, why don't you tell us a little bit about yourself and the Land Advisors organization?
Sure. So I'm the CEO of Land Advisors Organization. As Carter mentioned, the founder. Land Advisors Organization was founded in October of 1987 as a sole proprietorship. Over the past 36 years now, we have grown it into the largest land company in America, offering all kinds of services to our clients, which include the largest home building companies in America. It includes the largest master plan community developers and landowners of all types.
And Greg, we find ourselves in kind of strange times right now, and one of the things we're trying to do with the podcast is to provide timeless information that our clients and potential clients and users and consumers of land can go back to again and again. And the one thing that we know is, both of us having been in the industry for a long time, is the only thing that's certain in the real estate industry is uncertainty. So as we're sitting here today in uncertain times with changes in the interest rates and et cetera, how are the various different market segments that you're dealing with and the advisors of Land Advisors are dealing with adapting to these changing times?
Well, let's start with the word uncertainty, because it's a really important word, and that is truly why we see real estate development as it relates to housing, but really of all types. But let's focus on housing and land. That uncertainty brings with it, of course, higher returns. I mean, all certainty lies in maybe cash and T-bills, right, at the low end. And then toward the high end might be toward areas where we might view it as speculation. So land development and housing can be quite stable during certain times, but we know that stability could be shooken, and it has been. So as we look to the idea of these higher returns and risk-adjusted returns, and we look to them over the decades, land and housing has been a good place to be. We have to recognize there are cycles, and there always will be. However, this cycle, as we always say, it's different this time. And the difference this time is we think about the typical real estate cycle. It starts with building, then it goes to overbuilding, then an adjustment period, and then an acquisition period, and then back to building. So we think about it in that way for virtually every product type in real estate. The unique part about this cycle is we went from building straight to adjustment. We never did get to the overbuilding side of it. So I think that is a plus as we think about the length of the adjustment period. And it's very interesting, we'll get into this a little bit more, but we already are beginning to see signs of daylight here in January compared to, we didn't know what the free fall was going to be in October, November, and stark contrast. Other cycles are slower on the way down, and of course, much slower on the way out when we have large excesses to sop up.
Yeah. And it is really kind of crazy what we're seeing right now. I was just on the phone with some guys from Texas, and they're seeing daylight. Projects are starting to move forward. Builders are starting to call again. And we, as it relates to launch, I mean, I gave up counting over, we're working on financings of over 70,000 acres of land. So to your point, there's still a lot of lots that we're missing that ultimately will have to come online, and given the long time to get or runway to get the lots in place, everybody is saying what we want to make sure of is that we're not missing the next set of waves that come in. We want to be set up and ready to pull the trigger on the financing.
Truly, it's a long-term business, especially in master plan communities, and being ready is really important. The builders go in a herd for the most part. You have certain outliers with certain strategies, maybe time to expand into a market during soft times. So one of the parts of the question you asked earlier is, what are we doing during these interesting moments? And I would tell you that the rise in interest rates has been decimating to the land transaction side of the business, truly a bloodletting that has occurred. Most of the public builders, privates alike, have ceased all land acquisitions for the most part. It's really down by a huge percentage. Second to that, even the idea of spending entitlement dollars has been paused. And more importantly, is even horizontal spending has been paused. So all of that leads back to the idea that there is a coming shortage, almost a very quick V bounce rather than a U, and surely not an L. And the idea that we are keeping very busy servicing our clients related to, one, great market data and great insight with boots on the ground. Two is watching for these turns in the market that will cause the need for lots in the near term. More importantly, is looking at the potential structures that could be embedded now in transactions as the herd begins to stir and move. So sellers do not want to peg a price that we might need to underwrite today, as this still dismal outlook is still upon us. We can't necessarily find the pace for certainty or with regularity. We also are now, through rapid price discovery, maybe even adjusted lower than may have been necessary. So some form of structure to a current purchase would be more comforting, related to a look back. It's comforting more for the seller to not capitulate today in the price, and also for the buyer to say, I'm happy to pay you fairly, but I don't want to be compressing margins too much. And also IRR can be really lower as it relates to a slow pace coming out of this.
And I think you're hitting on something really important. So as we know, to some degree, well, in my world, it's all based to some degree on math, right? What is the residual land value of a piece of dirt? And obviously, you have to take a look at sales comps and other metrics in the market to determine what that is. But and we can drill down on this because you'd mentioned a lot of potential deal structures, and so land advisor. When your advisors are working with buyers and consumers of land, given the uncertainty that we're experiencing and trying to catch the dropping knife, everybody's afraid, how far is it going to drop? How do the consumers of land underwrite that transaction when home prices are coming down, costs are going up, interest rates are uncertain, may or may not be able to get money at what rates? So all of that, when it gets into the residual, makes things very difficult to determine what they can afford to pay for land. So with that having been said, and the competing interests of a seller of land versus a buyer, how do your advisors look at that situation? And you'd mentioned a couple of different structures that maybe you would like to drill down on to give the listeners, for those that may not be familiar with those terms, a little bit of explanation as how you might be able to put a transaction together in these uncertain times.
Well, look, in complete uncertainty, which we had starting in really July, August, surely September, October, all the wheels came off of any ability to underwrite. And in fact, I don't think anybody would come forward to Land Committee on a Monday morning to say, have I got a deal for you? Yeah. So that is the cease. Yeah. And I'm not telling you today, as of January, we're out of the seized up market. So first, it comes to the point where there is demand, which we are beginning to see. There is price discovery, which we are beginning to see. The other thing we didn't even mention here in the part of the cycle and other things that happen and your residual analysis, of course, one of the most important components is cost. And so we are, again, beginning to see some of the evidence that vertical costs are coming down and expected to come down further to much further. Horizontal costs are a little bit stickier, but we would also expect to see those costs come lower than they were during the frenzy of supply chain, labor, extreme shortages. So those are also beginning to loosen. Words of contractors calling builders versus builders begging. So I believe we are entering that idea that costs may come down. So when we look at costs in flux, now on the way down, we hope will continue and surely stabilize to not going up. Pace, which froze, beginning to come up. And as we look at price, we're probably in many markets too near the bottom that is pulling demand into the equation. The other part we have is still a very short supply of resale housing in virtually every market, and that is a big factor. Rents are another big factor because they are a stabilizing factor to value. We could look back to 2006, where yields on a single-family home in the boom and bust markets was well below 2%. They are today over 4%, maybe 4.5% on the median price with the median rent. So that is a bit of a floorboard. It's not bringing forward the build-to-rent industry we thought was going to be the savior of absorption. So that has seized up with the spread. So as we look to structure, there's a whole variety of structures. There's a joint venture, of course. There is a look back as a percentage of house price, which has been a lasting, we'll call it barometer, 18 to, depending on the market you're in, I'm not going to put California in the equation, but 30% is kind of the range. But there is a 22 to 25% kind of look back band that allows for a builder to, I think, see a decent margin, and that's important. The rule of 40, I don't know if the builders know it. Yeah. The builders know it, but all the listeners may not. But the typical rule of 40 that we look at and is the scorecard is a 20% unleveraged IRR and a 20% gross margin. Now, we know that the builders were way outperforming related to margin and IRR. We had a very good pace, we had a very good price, and even with rising costs, the builders were reporting 28 to 30+% margins. That's coming down. It's going to come much further down as we begin to digest a backlog that includes recent purchases. The other factor that we talk about is not just the new purchase, but the potential for working with the deals that are still in escrow, which are few, that could be retooled. It is the lot banking deals where there are kind conversations going on. I would call it that related to a push of maybe a quarter or two related to lot takedowns. We haven't really seen much other softening from the lot bankers, but I do think that there is some structure that could be embedded to say, I can help you here, but we also will square up down the road. Yep. So I think we're in that moment. Nothing like the 07, 08, 09 conversations, which were harsh, violent, with all kinds of bad behavior. So I think right now we're in a kind adjustment period, and we'll make it through. I think everybody walked into this with relatively full pockets, which I think is a big factor. There's a buffer there, and that is true, especially with the public builders. Just to mention another kind of a scorecard, when we look at debt to capitalization, the public builders are in some of the healthiest shape they have been. Yeah. Their typical spend on land is 25 to as high as 40% of their gross revenues. They have all but stopped that, and that land spend includes horizontal development. So when they stop that portion of it, when they harvest their backlog with still decent margins, the cash is piling in. So this bodes well for our industry. It bodes well for the long-term health of the builders. And of course, that relates directly back to our landowners and developers that will soon feed the machine again.
Are you seeing any investors, private equity, home builders looking for deals around the country, looking for a little pain that they may be able to solve?
So I would tell you, most of the sellers in the market recognize where it is, and they do not want to, capitulate to say, oh, what's your price today? So many kind of know the brackets on that and say, okay, just come back again when you're ready. So that's one factor that has just kind of, we'll call it, ceased. I would tell you that there's very few large transactions in the market. We have one very large one we took to market here just a couple of weeks ago, and the response has been great. The number of NDAs we typically get on our large-scale master plan community offerings, it's dead on target. The groups that are present are all healthy, all have capital set aside, as I had mentioned, and private equity had raised a tremendous amount of money that truly did not get spent, even through the we'll call it the big bulge of demand we had for capital and the building that went on.
So is private equity looking to potentially lower their expectations on what that return is, or are they wanting to double down and increase it even more?
Well, look, I think the issue here is returns. And with the spread, as we look to it now, and anybody in merchant building, build-to-rent industry, horizontal apartments, multifamily, industrial, the formulas got upended. While, again, we weren't overbuilt in most markets, although the beginning signs of multifamily was getting there. And I think this capital crisis that has gone on has really forestalled what could be building over the need to severe overbuilding has kind of been cut off. So that's a good thing. However, when rents are softening to falling, the pro forma doesn't show 3 to 5% or more increases. The costs still have not gone down in many sectors, beginning to see the costs come down, but they were way, way up. So we have formulas that are broken right now related to merchant building on the exit cap rate. The yield on cost is really, we've got a gap to fill. And I think that's healthy again for the markets. It keeps people on the sidelines. And that's really where we still are, a little bit of daylight beginning to show.
Yep. Is there anything that keeps you up at night, Greg? Kind of where we're at right now with this uncertainty?
I think what keeps me up at night is the private builders and how they're digesting their backlog and the health of them. Most are in good health, but it is uncomfortable when you're not able to feed the back end of your whip with the front end of sales. So that's one area of concern. From our organization standpoint, we went into this very healthy with a mindset to grow. We're in 29 markets now. Before the end of this year, we'll be in 33 markets. We're going to add 20 to 30 additional advisors, probably another 10 additional in staff. We're bringing on new services. Our Land Advisors Capital Group is wildly busy related to the disruption in capital flow. So the typical ease makes it very competitive. When everybody withdraws, we can really get busy advising on the capital side of the equation. So I guess what keeps me up at night is just strategy and how we move forward. And I don't think in 6-month or 12 or 2-year increments. I'm thinking more in 10 to 25-year increments, and you can sleep a little better that way.
Absolutely. And in closing, what are the biggest opportunities that you might throw out to the audience that they should be looking for or considering?
So I do think that if you're in the home builder capital side of the world, there's a lot of things that can happen, and that will include and still land banking, lot banking. I think the yields or the pricing on that has improved depending on the market and the size of the builder, but I do think that yield has improved, and it had to, again, because of the spreads. So that's an area of continued opportunity. There is a lot shortage, so as we look to it, we will immediately be in business to continue that funding. Joint ventures, and whatever form they may take, with a landowner all the way through, with a capital source that is providing, mezzanine finance, those are great alternatives. I still believe in land as a store of wealth. We never really got wildly out of hand related to periphery land that is in the path of growth. When we look at Phoenix, it's going to grow by 800,000 people a decade. When we look at our markets across the whole Smile States, there's population growth, therefore land and lot consumption. And so I do think if somebody has the long term in mind, the 5, the 10, the 20-year picture, we're seeing a lot of stirring there related to land as a store of wealth. So I see opportunity there. There is always opportunity, whether the market is going up or it is coming down to a point of recognition that it is time to move. And that's where we are at this moment. But the idle time is really the moment where you just have to sit and think, and what is your next best move? And that really began in June, froze up in July, August. Freeze is still on, and I expect a thaw beginning, especially in the spring. And so it's short versus the, call it the 8 through 11, just decimation, barely any noise in 12. I mean, years of disruption. So anyway, I think we're in better shape going into this one. We'll be in better shape as we begin to recover the idea that our population is growing, they need a place to live. And we sure hope that this 23 brings you health and wealth and success. So Carter, thank you for this. It's been really enjoyable.
Greg, I'd like to thank you for taking the time today to speak with our audience and how to look and view uncertain times. For those of you that would like to get in touch with Greg Vogel or the Land Advisor organization, we will put contact information in our show notes. And we really encourage everyone to share this podcast and others with members of your team, and follow us anywhere you get your podcasts. Thank you very much.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcast to never miss a new episode.